and welcome back to another MRMIA broadcast. I'm your host, Marc Leprince, and this is the Model Risk Managers International Association broadcast. And today we're continuing our credit scoring series with our returning guests, Pravin and Raymond. And this is where we discuss a range of topics surrounding model risk, from shock periods, benchmarking, and today we're actually going to discuss overlays. So to introduce our returning guests, we have Pravin, CEO of Analytix Engine, boutique credit and machine learning modeling consultancy. He comes with 20 years of experience in credit modeling, model risk management, and was a previous partner at Deloitte South Africa. Raymond himself, a published author on credit intelligence and scoring, and has over 25 years of practical experience. And before we begin our scheduled broadcast here, we have a special announcement to make. So as we've been doing these credit scoring series, we've been getting a little bit of feedback that they have questions to ask. And so what we're doing is we're holding a live Q&A session on Tuesday, August 17th. So stay tuned for more details. If you're a member, look for our email announcements and make sure you get registered so that you can ask your questions to Pravin and Raymond live. So today's topic is model overlays. And what an overlay is adjusting the model itself, its output, or some of the processes around it so that we can change our interpretation of the model, the resulting model output, so that it can better fit the business situation. So with that in mind, I'd like to direct my first question to Raymond. So what are some of the types of model overlays that can be applied?
There are a bunch of different ways in which overlays can be done. And one of the most basic is just to say the model isn't working, let's just get rid of it. You'd have to sort of go back to something that's a lot more simple, the use of basic policy rules, those rules that have been in place forever and ever within the organization, or the rules of thumb that have been used within the organization. But many of them are more complex and they can be applied at different stages. One is the model inputs, that what goes into the model parameters, though, which is what's inside the model outputs, that which comes out at the end, and then downstream, the decisions that are made based upon the model output, and potentially further along processing adjustments that are made within the process. Now, so with that, I'm going to pass over to Pravin sort of to cover a couple of the first points. Pravin?
Thanks, Raymond. And hello, everyone. So let's start with the top of Raymond's list, the model input examples. How can you change your model inputs to improve your model performance? And I'd like to cover 3 scenarios there. The first is changing your record weights. So when you're calibrating your model, you have input data, which you use to calibrate your model. And one way to adjust your model is to change the record weights. So the mix of the book that you're using to calibrate your model. And what often happens during a period of stress is that your population that's coming through your portfolio changes, either through particular populations stopping to apply or other segments of your population rapidly increasing their application. So by changing record weights, you can, using your past data, quickly change the mix of data that you're using to calibrate your models. The second way to adjust your model inputs is to do value adjustments. And 2 common examples that I've seen are, for example, disposable income. So for example, on your affordability metrics that go into your scorecard, for example, you may have disposable income. as a variable that goes into your scorecard. And during periods of stress, I've seen banks, even before periods of stress, in fact, I've seen banks stress that disposable income to see how the distribution would look in periods of stress. So you could stress, for example, the disposable income is one. The second that I've often seen people use is loan to value ratio. So often scorecards use loan to value ratio as an input measure. But what happens during a downturn in the market is that the value of that collateral itself also changes. And so I've seen banks stress the value of collateral, which in effect has the effect of stressing the loan to value ratio, which then changes the output score generated from the scorecard. A third and simpler method to adjust values is to change input floors or ceilings in values. So what often happens during a downturn or during a period of stress is that the range of values and the extreme distributions around some of the values increases or decreases rapidly. And by creating at a variable level floors and ceilings, you can create a degree of moderation. Obviously, all of these sound quite simple, but the actual application is a mixture of art and science. And so you would have to ideally test these things during periods of a benign economy when you've got time to think about it. But hey, if you find yourself in a stress and you haven't tested them before, it's quite easy to run scenarios offline. The next...
Pravin, there is one thing that was missed there, and that was adjusting the sample. Sort of taking certain cases, dropping out certain segments, or potentially including other segments that were never considered before. But I think more it's to say, okay, there might be cases that were considered in the past and they aren't valid anymore.
Correct. And just a quick question there, Raymond. So obviously when you change record weights, you can increase or reduce the weights of segments. How would you bring in segments that weren't considered before? Would this be actually bringing in additional data into your bull sample, for example?
So it would be, although just how that applies in the current context, I'm uncertain. But I think more, what would happen more is you would drop certain segments and say, these do not apply. We do not want to consider them anymore because they're out of the picture.
Correct. The only portion I would urge if you totally drop a segment, it's to be careful and to be sure that should a customers from that segment arrive, that your scorecard and your approvals process is able to manage them. And I think that's important to maintain. But otherwise, Raymond, you're spot on. If in addition to model inputs, we can also adjust the model parameters. And there you can adjust one or more individual parameters. So for example, you could give education, for example, more weight in your scorecard. For example, in a downturn, lots of people lose their jobs. But when the market turns, for example, graduate professionals find employment faster. And so you might want to give more weight to the variable that captures that, as an example. So another way to adjust your models would be to give more weight or less weight to specific parameters. If a particular parameter, for example, starts decaying rapidly during a period of stress, you may want to give that parameter a little bit less weight. The challenge obviously is to be cognizant of the correlations between your variables when you do these adjustments. Another method to adjust your model parameters is to do points adjustment. So if, for example, you're using a weights of evidence method, you have a number of points per bin for the variable, per grouping within a variable. So for example, if age is a factor in your scorecard, then for each age band, you would have a certain number of points. And another way to adjust your model would be to adjust the points per bin. And for example, you may want to adjust riskier segment points to make them less attractive, for example. Again, the important thing to be careful of when adjusting points is that the relationship between adjoining bins and points ranges doesn't give rise to funny things happening, to use the technical jargon. The next one is, sorry, Raymond. The next one that If it actually comes to that and you actually have to rebuild your scorecard or quickly recalibrate your scorecard, then you can adjust the tuning of your parameters. So for example, within your scorecard build, you typically allow for a maximum correlation, typically around 50 or 60 I've seen people use. You may want to change the maximum or minimum correlations that's allowed between, maximum correlations that's allowed between variables. Often when people are building a scorecard, they will also input a minimum information value per variable. And you could increase the minimum information value to improve scorecard stability, or reduce it to increase the range of variables that are included in your scorecard. Again, with the proviso that if you have too low information values on some variables, the scorecard is likely to decay faster over time. The other factor that we often use is the variance inflation factor. And I've seen people adjust the maximum allowable variance inflation factor. And my own personal favorite is the population stability cutoff, or the characteristic stability cutoff. And looking at that in terms of the variables that are allowed to come into your scorecard. So effectively on the model parameter side, you've got three options to adjust. You can adjust individual parameters. You can do points adjustments to various segments of your scorecard. And if it comes to redevelopment or rerunning your calibration, it actually adjusts the fine-tuning of the parameters so that you can change the cutoffs for what's allowed into and out of your scorecard. Obviously, the next thing that you can adjust, having adjusted your parameters, is your model output. And Raymond, maybe you can give us a bit more info on that.
Thanks, Pravin. With a model output, of course, you can do stuff judgmentally or empirically. So either just sort of do a thumb suck or apply some analysis to it. And sort of when sort of shocks really happen, a lot is just judgmental because you haven't got the time to go back and do the analysis. And that is what happened with COVID-19. But there are several ways in which it can be done. So, just to have an adjustment to the constant that's going into the model. Of course, I'm talking about a logistic regression or a regression model. It could also be applied to machine learning models, but it's a bit more complicated. And then so the differentiated adjustment, potentially having a greater adjustment for the riskier cases and a lower adjustment for those that are of less risk. But the one thing that's going to happen, and you could have this not just with high risk, low risk, it could be varied across the risk range. But ultimately, what has to ensure that the ranking holds if you're going to do that, just applying it to the model output. There could also be a differentiated treatment by segment, applying one adjustment to one area and another adjustment to the other area. Of course, with COVID-19, travel and entertainment and restaurants and everything else got hit badly. One might apply greater conservatism in those areas, have a different constant adjustment or some other adjustment that varies. And the similar thing happened with the poultry sector during bird flu. They got knocked, so one would have just treated them also slightly differently. So beyond that, one could get into the strategy adjustment, like what are you actually going to do with the model output? Pravin, that's to you.
Okay, perfect. So once you've got your model, you don't always have to adjust your model. Sometimes you can adjust your model, but you can also adjust with what you do with output from your model. And this we refer to as strategy or business adjustments. So these are decisions that you make using the data that comes out of your model and how you change your response to that model output. The simplest and most common adjustment to make at a business level is to change the scorecard cutoff. Effectively become a bit more conservative by reducing the lower end of customers who get approved on your scorecard. Implicitly, though, this does assume that the ranking on your scorecard holds and that the customers closest to cutoff pre-crisis are the same as the customers who remain closest to cutoff post-crisis. But again, the simplest and easiest way to adjust your scorecard in the absence of other information is to just change your scorecard cutoff to become a bit more conservative, again, with the risk that you might lose market share. Then the second method that's often used, and I've seen this more often in the corporate segment than in the retail segment, is to do what I refer to as notching adjustments. So often in a corporate credit, customers have a scorecard, and they will often have, for example, a guarantee from a parent or a holding company, or from insurance for that matter, credit insurance for that matter. And these adjustments will often result in a notch adjustment to the better. There's nothing stopping you during a period of crisis to do a notch adjustment to the negative. So for example, in a COVID world, if people work in a tourism or traveling industry, there's nothing stopping you, assuming you can identify the segments, moving customers in the scorecard down a scorecard band. So to say your scorecard band might say that you are middle risk, but because you work in an industry that's highly impacted, we think you're now slightly higher risk. One of the important things to think about is often scorecards are designed with certain features and certain shapes in mind. The most common being a number of points to double odds, which means that the notches are non-linear. So when I say notches, the credit score bands are non-linear. So when you move one score band to the riskier side, at low risks, the impact is not material. But at higher risks, the change in the implied PD or default rate can be very material. This may be a desirable outcome, or it may give rise to too much conservatism. So just when you do notch adjustments, they are simple to do. The nice thing is if you can identify the risk segments you want to adjust, they can be very focused. But you need to be careful that at the extreme ends or at the medium to high scoring bands, the impact is not exaggerated. The other thing you also need to be careful of is that your scorecard remains monotonic, which is quite important. The next adjustment, common business adjustment that happens is to adjust spending limits. So to still approve customers that you would have approved before, but to reduce your exposure. So basically reduce the total amount you could potentially lose by reducing the total lending amount. And you could either do this uniformly by applying a scaling factor across all limits, or you could do it on a sliding scale basis where the riskier bands have a higher reduction in lending limits and the safer bands have a smaller reduction in lending limits. The next adjustment that I've seen people do often is a pricing adjustment, where you continue to lend at the same rates and you continue to lend at the same limits, but you actually increase the price of borrowing, particularly when markets become highly inelastic. So the demand for credit continues to increase and other lenders are reducing their risk appetite, then this presents a good opportunity for profit making, but it also presents a good opportunity to get some bad press if you are seen to be profiteering. The other point to bear in mind is that you can charge as much as you want. If customer defaults, you don't collect that premium. So that's also something that's important to bear in mind when pricing. You could also ask for more security and change the mixes and the haircuts on eligible security. Earlier, I mentioned the haircuts on security values by certain security classes. So you could haircut the volatility and the for sale value of security that you admit. You could ask for more security, particularly for the riskier credit bands. So a number of collateral adjustments are possible. At a macro level, you could also do portfolio caps. So instead of adjusting individual customers, what you could do is adjust your lending limits in terms of the total amount that you're willing to lend, either per customer, per segment, customer segment, per channel, or per collateral type. Again, this is a mixture of art and science. And the nice thing is once you've got limits per segment, you can then choose the best risks per segment, which allows you to maintain a diversified portfolio while at the same time improving your overall performance result. So that is quite good. One thing that is I often recommend against is totally closing the limits to any segment. Because one of the things you do want to do, especially in times of crisis, is collect data. So while you might drop your limits in highly risky segments by a lot, I often caution against totally closing off a limit or a segment, because then you lose the opportunity to actually collect data, and then you just don't hear the music.
Yeah, the risk-based processing, so it can be risk-based or it may not be. One could apply blanket rules. Of course, sort of one thing that can happen sort of during times of stress is that you want to have increased documentation and verification of course, this is speaking for the originations process, along with the employment and income validation, sort of for the through the door applicants. And one could also, okay, I've got, I think, cut here. So the stop recording. Thanks, Pravin. One thing about this is that I have this down under the heading of risk-based processing, but it doesn't necessarily have to be risk-based. It could be just some blanket thing that's applied sort of throughout. But the most obvious, at least in the originations context, is to increase documentation and verification requirements for through-the-door customers. That's employment and income validations. One could also look at certain levels within their transactional spend, but spend by category in monetary terms, and certain categories like sort of food, rent, etc., etc., etc. The categories could be varied depending upon the circumstances. Also, looking at recent debt extensions and sort of the number of inquiries to see if there's been a sudden uptick in the calls for debt, if the basically liquid funds have run out. And thereafter, kind of drilling down, greater drill down into credit reports rather than just relying upon a credit score. Say, let's take a look at the credit reports a little bit more closely, because there is stuff there that we typically ignored and relied upon a credit score, but we can get greater value by greater interrogation. And thereafter, the differentiated use of available but ignored data sources. Now, something that happened with COVID, a lot of lenders were heavily reliant upon the bureau scores, as mentioned, and they had lots of transactional account data that had just been ignored. And they started looking into it and found that there was a lot of value, whether it be to check to make sure that the paycheck was still coming through, that it was stable, or there were lifestyle changes. Again, this is if you have the capability to sort of drill down to the transaction level and look at, did I spend it on gambling? Did I spend money on groceries? Just where did the money go? The other approach, and I'm going to pass this one back to Pravin, was to look at financial construction. Pravin?
Thanks, Raymond. So over the years, I've had the chance to play with quite a lot of transaction data, and typically from your current account or your transaction account, as well as from your credit card account. And this data is phenomenally rich. And if you look at it, you can actually do quite a lot in terms of trying to understand your customers better. And the nice thing about this is it has a risk management benefit, but it also has a marketing benefit. And so can also give you prospecting insights as well in good times. So definitely an investment worth making. In terms of just the lifestyle changes that Raymond mentioned earlier, for example, one of the things we've looked at in the past is just looking at, for example, the clothing brands that people shop at, and to see whether people move to more premium department stores versus more, let's call it affordable department stores and supermarkets. Being able to see that type of change in people's actual spend behavior tells you a lot about the economic pressure they're under, as well as the level of conservatism different segments of your population have in terms of times of stress. But coming back to the full financial construction, as Raymond calls it, I often refer to this as creating financial wellness measures. So if we take a customer and we can see his cash flows, then what wellness measures can we create on that data that allow us to better understand this person's lifestyle so that we can better serve them? And I often look at this in categories, and the first category being your income statement. So on a month-on-month basis, how much income do you get? How much of your income is stable? How much of your income is subject to commission, for example? How much of your income is volatile? That is a very easy measure to get from a current account, particularly if their salaries are being paid into it. Likewise, you can also then look at the expenses that outgo on a month-on-month basis. And there you're looking at the income versus outgo. So is the person running out of money, let's call it on the 25th of the month, or is the person running out of money on the 15th of the month? And as you go into periods of stress, do you see people's accounts run out of money faster? The converse is also true. Are people starting to cut back and manage their finances better? So their total spend goes down and they become more frugal. So you can actually separate out customer characteristics quite a lot by looking at the income versus outgo of on their income statement through their current account, for example. The next area that we often look at is their balance sheet, where we try and look at the customer's total borrowing and total savings. The one limitation of this is that if you only have internal data, you'll obviously only see the savings and borrowings that the customer has with you. But globally now, the number of data aggregators has improved a lot. And so often, again, subject to privacy rules and having the customer's permission, you are able to build a balance sheet view that shows people's savings versus borrowings. Because, for example, if you take a wealthy individual who has, for example, and this is an extreme example, a lot of family money, they may have very little income and high outgo, but their balance sheet comfortably supports lending or maintaining an overdraft, because you know they have a lot of access to, let's call it, reserve savings accumulated over time. So looking at the total savings that a person has versus total borrowings is quite useful. Again, in this case, I would strongly recommend looking at market aggregator data as opposed to just your internal data. And the last one is just cash flow statements, pure cash flow statements. Looking at how much of cash is coming in, particularly if you've got time series for that customer, if the customer's been banking with you for a while. The other measure that I find very useful is the volatility of cash flows. So what is the propensity of that customer to be hit with unusual cash flows? How stable is their cash flow? How stable is their net cash flow? That becomes quite important. So while we look at the net cash flow, we also want to look at the stability of cash flow. And all of these, let's call it financial wellness measures, as I refer to it, the income statement measures, balance sheet measures, and cash flow measures can be really useful in trying to separate your customer base to identify customers who are distressed versus customers who are managing well, and customers that you are willing to invest in terms of increasing the helping hand that you're willing to give during periods of stress. Again, the customers that you help in times of hardship are the customers that are with you for life. So there is often a trade-off between customer service and customer support and risk management. With that, over to you, Marc.
Actually, so I've got to do the wrap up here.
Okay,
sorry, Pravin. Also, to make a couple of comments on that. Well, you mentioned the data aggregators. That is something that is more particular to countries that have the open data initiatives. The United Kingdom and European Union, with their open data, there's a lot of stuff that's being done there. Where we are in South Africa, it's still in the very early days. I don't know exactly what's happening within the United States and elsewhere. The other point is on the cash flows. That's something that doesn't apply just to stress scenarios. It applies in the normal course of events, and it applies especially to businesses, and especially to small businesses. I looked at that and just found a simple coefficient of variation measure came into a scorecard when I was trying to do it, basically saying the more it fluctuated, the higher the risk. But beyond that, just as a bit of a summary, I'm going to do the Toastmasters thing, where you say, this is what we're going to tell you. This is then tell them what you're going to tell them, and then tell you what you told them. So this is that last one. So basically there were sort of 6 points. If you've got sort of the stretched scenario like what we've got currently, you just sort of throw out the model and revert to the business logic. Although the initial part of this pandemic is over, most people are trying to do something a little bit beyond just reverting to simple business rules. But thereafter, we look at the changing the model outputs, model inputs, what kind of goes in through the front door, the model parameters, what happens inside the model as you are making it, like the inside of a factory, and the model output, what comes out of the back door of the factory that's going to market. And thereafter, it was the downstream decisions that were based upon the model output and adjustments as part of the processing. So, Pravin, do you have anything that you wish to add on that one? Further as a wrap up?
No, I think you've covered it very well, Raymond. So quite happy with it.
Okay, Marc, it's all yours.
Yeah, this is a fantastic discussion. And it really demonstrates the types of overlays, the kinds of overlays that businesses can use to apply to their models. And what's been fascinating for me is seeing and learning the different types of adjustments you can make outside of the model itself. And so, while I know a lot of the examples you guys provided applies specifically to credit scoring models, these principles broadly apply to models in general. And so, if you got any final thoughts, I can bring us to a close here.
I think we've covered it.
Okay, excellent. Well, to our listeners out there, thank you for listening, and we hope you get to tune in next time. And remember, this is just a quick reminder that we have a live Q&A coming up with Raymond and Pravin Tuesday, August 17th. So stay tuned for more details. Take care, everyone.
Bye-bye.